Welcome to episode 29 of Fundraising Demystified. Today we have Kaustav, founder and CEO of Efficient Capital Labs, a cross-border fintech that provides working capital to SaaS startups around the world. He's raised a $10 million seed and a $100 million debt facility as a first-time founder. Kaustav shares his background as head of risk for American Express and several other unicorn startups, and how it led to him identifying a gap in cross-border financing. We even dive into the weeds, what types of alternative financing are out there for startups at different stages. And this episode is a must listen for all founders to get a masterclass on accessing working capital. Now, as a reminder, be sure to get notified of our weekly podcast and newsletter by subscribing at join.thunder.vc. Again, that's join.thunder.vc. Now, onto the show. All right, welcome back to the show, everyone. If your host here, Jason Kirby of Fundraising Demystified, and today we have Kaustav, CEO and founder of Efficient Capital. Welcome to the show.
Thank you, Jason. Thank you for having me. Excited to be a part of this podcast.
No, I'm excited to have you on and share your story. And I'd love for you just to give a quick background to those that are watching today, a little bit about you and how your risk management background led to you building this company and kind of where you're at today.
Amazing. Again, thank you. So my name is Kaustav. I'm the CEO and one of the co-founders of Efficient Capital Labs. We are a revenue-based financing company, and we specialize in helping SaaS companies and their growth journey. And another specialty that we have is we focus on US and South Asia and Southeast Asia corridor. We're going to talk about a little more of it, what exactly is our USP, our unique selling proposition. For me, as a founder, I have, as you rightly pointed out, of an extensive risk background, been in risk management domain for 21 years. Started my career with American Express. And entire American Express, I did everything to do with commercial risk. I did small business, I did merchant, I did pure commercial risk. And after 2008 and 9 crisis, I was one of the first few people to start the fintech division of American Express. I was a chief credit officer for all non-card lending. Started off with merchant financing, and then eventually we did working capital and supply chain financing. And from then, I jumped on to become the chief risk officer of Cabbage, which eventually, by the way, I'd left by them, but got acquired by American Express. But I had moved on beyond that. So was with Cabbage for 3 years, been a part of the amazing journey that Cabbage had seen. It's SoftBank funded. It's one of the premier and primary fintech lender / platform in those days. Then I played multiple chief risk officer roles till end of 2021. I was the global CRO for a buy now, pay later company. And after 2021 is when I jumped on this journey of building revenue-based financing through Efficient Capital. And I always give this example that my wife says that it was being bit with entrepreneurship bug. So I'd worked for many smart founders. I still advise many of the fintechs. What I wanted to build was something that not only plays to my strength but also solves a business problem. And that is how the Efficient Capital Labs germinated, in which we focus on cross-border SaaS companies, and our entire intent is to make capital border agnostic. Like whenever you think about South Asia, Southeast Asia, and whenever people think about raising capital, whether it's equity or debt, cost of that debt capital is a lot more expensive than any developed market like a Europe or America. And what we are trying to do is bridge that capital gap.
Gotcha. And, at this point, how long, have you been running this business? How much capital have you raised to date? And in your case, you raised equity and a debt facility. So if you kind of share a little bit more about that.
Yeah, so we have raised around $10.5 million of equity, which is a seed round and a pre-series A. We've got amazing VCs backing us. We've got QED and 645 Ventures to Premier. We've got quite a few of medium-sized VCs that have also backed us, like Everywhere Ventures, Riverside Ventures, Sync Capital. So amazing set of VCs. It's great to get ratification. So that's where we have raised $10.5 million of equity. We have also raised $100 million of debt facility through CIM, right? And for people who may or may not be familiar, so I will explain the difference of what is an equity capital and what is a debt capital, because sometimes $100 million sounds overwhelming, but it's a very important nuanced difference between what is an equity capital and debt capital. So simple way of thinking about it, an equity capital is you can use it for whatever you want. You can use it to lend. You can use it to buy a laptop. You can use it to hire people. You can use it for AWS. Anything that you as a founder or as a founding team, you want to use it for, that's where you can use equity capital. There is an unhinged way of using it. A debt facility, on the other side, can only be used for lending, right? If you are a lender, and a lender means you can be of different types of lender. You can be working capital, you can be supply chain, you can be factoring company, you can be a credit card company. It really doesn't matter. If you're a lender, you use the debt facility. And again, not getting into there could be different types of debt. It could be a warehouse facility. You can do a forward flow. There are different ways of raising capital when it comes to the debt part of it. So we raised a warehouse facility with CIM, which is a $100 million debt facility, which can be used for lending. And unlike equity, a debt facility comes with covenants. What that means is what you can or you cannot do. Just because you can lend doesn't mean that you can lend wherever, whatever, whoever you want to. There are certain covenants that you and your facility provider agree with, and then you have to stick to that during the course of that facility that you still own.
No, and I want to unpack that a little bit more. So when it comes to getting a debt facility, now your business in particular, and actually let's take a step back. For people that aren't familiar with revenue-based financing, can you give a quick education to founders on what revenue-based financing is and how those deals are underwritten?
Sure. So a revenue-based financing, simply put, and it could be a retail or e-commerce revenue-based financing, or it could be SaaS. We focus on SaaS, is we upfront your capital. So let's think about, let's say that you are a platform company and you are an HR tech platform company, and let's say Citibank is using your platform for all HR related purposes. And Citibank for usage pays $20,000 every month for using their platform. So you make $250,000 or $240,000 from Citibank for the platform usage. What we will come and say that we'll upfront a portion of that capital so that you can use it for whatever you deem fit, right? Especially for a growing company, especially for companies that pre-seed, seed, Series A, Series B. Getting that upfront capital, is the ROI of getting that upfront capital is a lot more than getting it every particular month. So that is what we do. So in this particular example, of that $240,000, let's say $120,000 we pay you upfront. Now you use that capital to build more features. You use that capital to go and pitch to another bank. You use that capital to go to a GTM for another market. So it's a utilization. And so we front load the money that you would have got from a particular contract. We give that to you upfront.
And how does that hit the balance sheet? Is that seen as like collateralized debt? Is it seen as, accounts payable? How does it impact a founder's balance sheet?
First, you use the words collateralized, right? So most revenue-based financing companies would not be collateralized. And collateralized is a little bit of a nuanced term, right? And I'll explain to what that means. Sometimes when we think about collateralized, we think about you have to give something like a CD or a letter of credit, a certificate of deposit or a letter of credit is the usual definition of collateralized. But in the legal definition of collateral, you can also file a lien. And if you file a lien, it is also deemed to be collateralized. But there are certain revenue-based financing companies that makes it uncollateralized. What that means is there is no lien filing. There's no upfront letter of credit or certificate of deposit that is there. But there are also certain other players within the revenue-based financing space, especially the ones that does much bigger amount, especially the ones that does longer tenor. Without getting into names, some of them do file for liens. Right. And that is what makes it collateralized. Right. Now, in terms of balance sheet, right. So in terms of balance sheet, depending upon, these are all current liability, right. Especially if you have to pay it off in less than 12 months, it is going to be part of your current liability. Sometimes, as I mentioned, some of these revenue-based financing companies can actually give it to you for 2, 3, 4 years. Then it not only becomes your current liability, which is the 12-month portion of what you need to pay, but it is also a long-term liability for what needs to be paid back, right? So that is how it will show up as your current liability on your balance sheet.
No, I'm glad you shared that. I just feel like a lot of founders don't know how RBF works, and from like a payback period. So yeah, usually less than 12 months, sometimes 18, sometimes longer, but it's not necessarily really an interest rate. It's usually a percentage of future revenue is how most of them are underwritten. How do you guys determine what percentage to take, and how do you determine when it's officially kind of paid off, taking into consideration your percentage that you need to make in terms of interest?
So there are 3 types that are there, and not to make it a lot more complicated. The first one, which some of the people would call it like a merchant cash advance, it is a percentage of your revenue. So what does that mean? And there are pros and cons to that. The percentage of revenue, what that means is if you are volatile, if your revenue is not as predictable, it can potentially help you, because in certain months, let's say you do 50% of it, you don't want to pay a fixed amount because the revenue that you have made is not as much as you made in the previous month. So the amount that you're paying back falls or goes up depending upon the revenue that you're making for the month. So which is a percentage of your revenue. Now that's the advantage. What I gave you is the advantage, right? So it means that if there are certain months in which you're not doing that great, the amount that you need to pay back goes down. The disadvantage is if you're a growing company, where most of the company that we go after are growing companies, right? Which means that your revenue per quarter is growing up. At a certain point in time when you're estimating, when a usual RBF players are going to estimate, they're going to estimate looking at your growth till that point in time. And they are going to calculate, if it's a 12-month, they'll calculate what needs to be done for you to be paid back in 12 months. But if you're a growing company, what happens is that you end up paying it, depending upon a growth rate, 6, 7, 8, 9 months. So what you are doing, your effective APR or your effective rate that you're paying becomes much higher than what you anticipated it to be at the point when you got it. So that's the disadvantage of it, right? So when you are a growing company, you may not want to take it as a fixed percentage of your revenue, because you'll end up paying a lot more, as a result of which the companies are higher, the MCAs are high, the MCAs are happy because they are getting a lot higher yield on that particular thing. So that's one type of MCAs that are there. The second type of MCAs that are there is which is what we do. We do it as a fixed fee. So what that means is we go after predictable revenue. So you exactly know every month what needs to be paid in terms of principal and what needs to be paid in terms of interest. Right? So there is no surprises. So you can plan accordingly. It doesn't matter whether you're growing with 30, 40, 50%, you pay exactly what you need. Again, the reverse of it is true. If there are certain months in which you dramatically are lower, it might pose a little bit of an issue in terms of repayment, but especially for a growing company, we always advise, doesn't matter whether it's a friend or existing customers, we always advise to take a fixed payment. It helps you in terms of your yield. The third type of revenue-based financing company that are there is, it's not technically a revenue-based financing company, but it's more like loan, in which there's a balloon payment. What that means is it's interest only for a certain period of time. It could be a year, it could be 18 months, and then you repay that entire amount at the end of that period, right? And there are advantages and disadvantages. The advantage is for that period of time, you're paying interest only and you're not paying principal. The disadvantage is, especially in certain markets, especially where we are right now, that balloon payment puts a lot of pressure on everything that you have. Then you're looking at refinancing. Then you put yourself in a little bit of a pickle, depending upon how big it is. Those are the three typical types of RBFs that you would see.
I think that I really appreciate you sharing that and breaking down the different layers of opportunities that founders can at least start to think about, how this might play into their business, especially for revenue generating businesses that want to look at this. So appreciate the education. Let's kind of take a step back. You raised from some pretty prominent investors, pre-seed seed, and of course, the debt facility. What was your strategy? How did you go about getting in front of the right people? At what point were you at with the product to go out and do that? And
yeah, and it's a good learning exercise. Like the way I said, it's learning by doing. I faltered, I stumbled, and then I learned. And if anyone ever comes to me for advice, I can say what to do and what not to do. So I started fundraising back in November of 2021. And we all know that in 2021 was during the heydays of people being able to raise funds. So the entire thing, and it's a very personal story. So the entire thing, the way it started was I started talking to a few of my VC friends, people who were entrenched in the market. And the feedback that I got was, Kaustav, the idea is great. With your risk background with Amex and Cabbage and so on and so forth, we were looking to raise around $5 million at that point in time. It's going to be a breeze, right? It's just going to be a walk in the park. Don't worry about it. And so November and December, I spoke to only 5 VCs, right? The top 5 VCs. Again, without getting into the names, like big names, I spoke with only top 5, right? Some of them showed, QED was one of them. So some of them showed interest. Some of them showed a lot of interest. The other 3 said no at the very beginning. And come, I would say January 1st or 2nd week, which is 2.5 months, things were starting to get a little bit difficult. The answer was no from all 5. right? Including QED at that point in time. So I was in square one, right? What I realized was I did not, and that was the learning, I did not spread the net, did not cast the net wide. I spoke to only five of what I considered to be top VCs, and I had wasted 2.5 months of time just doing that, right? Because another disadvantage that I had at that point in time was I did not have a product. So it was me and my co-founder. I had a great pitch deck and I had my resume, and I was selling those two things at that point in time, right? So after January, I started casting a much wider net, speaking to different types of VCs, people who specialize in fintech, people who are in New York that I can go and have a conversation, people who specialize in pre-seed and seed as opposed to going to multi-stage funds. And I got introduced to amazing funds at that point in time. And one of them was 645 Ventures. And we immediately hit it off and we raised the first seed round with 645 Ventures, right? So that was one of the biggest learnings that I had is don't put all your eggs in one basket and try to diversify. So 645 was the first investor. We used that funding to build a really, really good team. We started building our first product. Sometimes it becomes the chicken and egg situation when you are doing a lending. It's a very important thing. When you are doing lending, it's always the chicken and the egg. When you speak to an equity and when you speak with a VC who knows fintech, the first question they'll ask you is, do you have a debt facility lined up, right? And when you speak to a debt facility player, the first thing they'll ask you is, hey, do you have equity lined up? So because there's always an advance rate concept. So what is it? So here is where my experience of knowing a lot of debt facility providers helped, right? Given my background with Cabbage and with Petal and so on, I knew quite a bit of a debt facility provider and was lucky enough that I had three debt facility providers who were willing to give us a directional term sheet, right? Even without equity, right? For me to show it to the equity players, right? That is one advantage that I had. So I always say that I was very well covered on the debt side. I was absolutely not covered on the equity side. And during the due diligence, 645 spoke to one of these players that was there, and that gave them a lot of confidence because they knew that we already had a term sheet from a debt facility provider. That is one thing founders need to keep in mind, that when you are doing anything to do with lending, then how do you solve for the chicken and the egg? And by the way, we did not do it, but another way of solving for it is you raise a certain amount of equity and you use the equity to lend. So you build a little bit of the book with that equity for lending. Then you go to a debt facility provider. By then you'll have a product. By then you'll have a platform. By then you'll have customers. You have something to show. So anyway, so that is how our journey went. Then with the equity, we were able to close our first debt facility back in November with CIM. It was a smaller facility, which we call a promissory note. It was a $15 million promissory note. But that particular term sheet that we got had economics which would unlock if we raised another round of capital, and the economics would become a lot better. The interesting thing, again, another learning, and this is another learning that I heard from my VC friend, is raising capital is almost like joining the dots, right? So what I did this entire 1 year of 2022 was I picked certain VCs, and when I was not raising capital, I kept on presenting to them. The best time to present, and this is when you're not raising capital. So I kept them engaged, and one of them was QED. So even though QED did not come in during the first round, I kept them engaged, and we showed them the growth. We showed them that we closed a debt facility in the $15 million promissory note, and they came in for a pre-series in December, right? And that is when we closed with QED and 645. 645 continued to believe and invest in us. And QED and 645 closed the pre-series A, which was a $7 million pre-series A that we raised in December. And it's always like self-fulfilling. And because we were able to close the pre-series of $7 million, we then went ahead and was able to close a $100 million debt facility in July with CIM back again, right? Now that we have closed the $100 million debt facility with CIM, our conversations as we are going for a Series A becomes easier, because now we are completely covered from the debt facility side, at least for the next 2 years, maybe even for the next 2.5 years. So for a financing company, you always are in a capital raise mode, but it is like the debt helps the equity, which again helps the debt, which again helps your equity raise.
I think that's something, the chicken and egg problem is something founders complain about all the time. And I think it's that straddling where you kind of get a little bit of a commitment. The other side, you kind of like play both sides. And I think that's a crucial tip to share. And being that this is a competitive space, like you're not the only player in this type of financing solution, albeit I think the market's been growing, and I think more and more founders are looking towards this option. So I think it's a bigger pie that's accumulating. How did you differentiate yourself? I think you have the Southeast Asia element to it, but beyond that, is there a proprietary underwriting that you have? Is there tech? Like what? How did you kind of go out and differentiate in this space?
The biggest differentiator, Jason, is we are the only revenue-based financing company. We are not only cross-border, but we do our risk cross-border too, right? So we have got like entire infrastructure built in different markets to do risk assessment, not just in one market, because we solely focus on cross-border. And that is the biggest differentiator. We just don't focus on one market. We have not built an infrastructure just for one market. We've built an entire platform to look at multi-market when we are doing risk underwriting.
Gotcha. And okay, I can see that because that opens you up to a whole larger amount of opportunities than just businesses that are just doing business in the US. Now, I appreciate you kind of adding some insights there. And when it comes to, what you look for in terms of underwriting deals and just for the audience here that might actually want to use you guys, what are you looking for in a company? What's the typical criteria that you guys look for?
So we are very flexible, right? Like, again, I cannot speak for the other. There is no one condition that eliminates you, and there's no one condition that approves you, right? So just because your net margins or EBITDA margin is negative, severely negative doesn't eliminate you, or just because your margins are positive doesn't mean that you're going to be approved. We look at a bunch of things, right? We look at your banking data that gives us view in terms of your revenue, in terms of predictability. We look at your other accounting data that gives us view in terms of your debt capacity, like, how much you already have, how much you think you need to pay. We look at your contracts, like we look at stuff like, you could be a $2 million company ARR, but what if the $2 million, 1.5 is coming from one particular company? There's too much of concentration risk. What exactly if we lose it? So we look at contracts. We look at whether, you're VC funded or not, whether for how long you've been business. And again, I don't want people to leave with the impression that if you're not VC funded, it is bad. It's actually not. You could be, we've got 20% of a company that are bootstrapped, right? And it helps in a way if you're bootstrapped also. So there's no one condition that eliminates, and there's no one condition that makes you better off that are there.
So the best thing to do is kind of see if one, you need this type of, need additional funding, and apply and see where it goes to kind of see what options might open up. That's something that we help founders with all the time is like, okay, like how much capital do you really need to kind of hit the next milestone? And you really need to go out and run a fundraising process for venture capital, or can you follow going after working capital, RBF, term loans, these types of things to kind of see if you can, in most cases, get capital quicker in a lot of ways. You won't get maybe as much because there's certain caps based on revenue and whatnot, but maybe you don't really need that much. And you can kind of do what you gotta do.
Right. So one thing that I'd add is that what we try to do is we avoid being the lender of last resort, right? That is one thing. We do not want to be the lender of last resort. What that means is if you've tried raising VC, it has not worked. You've tried raising debt, it has not worked. You've tried going to other places, and now you've got 1 month of runway. Your revenue might be exploding, but you just have 1 month of runway. So that is something we tend to stay away from, that we never want to be the lender of last resort. And another important distinction, like there are 3 types of capital that you can raise, right? And Jason, probably you know this, but for other, there's VC, there's a venture capital, then there's a venture debt, and then there's alternative capital, right? Alternative capital, it could be revenue-based financing, it could be working capital financing, it could be supply chain financing, fashion, whatever. And there's a subtle way of differentiating, right? A venture capital, the way I explain to people, is always a multiple of your revenue, right? When you are looking to explode, when you're looking to grow, when you're looking, make it a hockey stick growth, you're looking for multiples of your revenue. You can never substitute it with the third part of it, right? You can substitute a part of it. A revenue-based financing or alternative capital is always a fraction of your ARR, right? It's never a multiple. So that's one good way of doing it. And there are pros and cons in each one of them. As I mentioned, like right now, the VC market, if you might be raising multiples, but you're giving away an arm and leg in terms of your company. If you don't need to do it, you shouldn't do it, right? You would rather get to a valuation. You would rather get to that one particular customer. I always consider us not the lender of last resort, but your last mile. So that last mile to help you get to that valuation, your last mile to help you get to that ARR, your last mile to help you get to that enterprise contract before you explode. So we are an enabler of that last mile.
That's a really good way to look at it. And that's how I see it. It's just like, hitting that milestone, you just need a little bit more to hit that certain MAU count, user count, or revenue metric. I think is a really good way to look at it. And it's how founders should be looking at their business anyways. They should be looking at the milestones that they need to hit to achieve a capital raise or be attractive to a more formal capital raise.
Did you know that most founders waste days of their lives chasing the wrong investors? Well, as a founder, your time is your most valuable resource. Don't waste it on the investors that aren't going to write you a check. Here at Thunder, we built a free tool that identifies exactly which VCs are worth your time to pursue. We score your company against 3,500 VCs and family offices that have been vetted and are actively writing checks into companies like yours. Get your AI recommended list of investors that will look like this absolutely free by creating a free profile at Thunder.vc. You can upgrade to premium to download this list, export it to any tool you wish, and get their contact information and access the data on their portfolio companies to map out a path to warm intros and build your founder network. Sign up for free at Thunder.vc. Now let's get back to the show.
When it came to your experience kind of fundraising the debt facility, you mentioned the firm, you have a background, you've been in the space, you probably already had a couple lined up. How are these debt facilities structured? If you can kind of enlighten, the audience here, because there's a couple startups I've worked with in the past that have sought this out.
But again, another big learning is, even though I thought I knew a debt facility, right, which I would say that from a regular person, I probably might be a little bit better off, but there was a lot of things to be learned, which I learned during the course of it. I understand the basic thing. What is an advance rate, which people may or may not know, right? Like, what is SOFR plus this, and what is it that you need to negotiate? But there's so many other small, subtle things that we learned and that needs to be kept in mind. So my advice that I would very strongly say, that if somebody is going for anything to do with debt or going to a debt facility, try to think of getting a fractional CFO or a fractional capital markets guy. No matter how smart you are, there are many things, there are many nuances. And these debt facility term sheets that you sign are long-term term sheets. These are not 6-12 months. They're 2, 3-year, 4-year term sheet. What you're signing right now, you have to live with it for the next 2, 3, 4 years. So it is imperative for you to know some of the nuances. It's imperative for you to understand this, and it is okay for you not to know everything. So that's why I would always advise for somebody who's getting into lending to invest certain amount of money, maybe not to hire a CFO, I understand, or maybe even not to hire a CRO, but to invest in fractional CFOs or to invest in fractional capital markets people. The value add for that, the ROI for that is a lot more, which we'll only realize after we have gone through the term sheet negotiation. So that's another very strong advice that I would give anyone who is thinking about doing a fintech which includes or which involves lending.
In this lending world, like there's got to be essentially a spread. Like you have a cost of capital, on that, to where, I imagine there's maybe some, fixed cost. And when you deploy that capital, there's essentially that it's not like you get $100 million in your bank account. You're drawing upon that when you're doing deals. And I imagine there's probably some kind of fixed cost. You don't have to share, obviously, the exact numbers, but there's some kind of fixed, and then maybe some performance upside back to the lender to kind of juice their returns. Like, is that kind of what you experience? Or are there other types of ways that these debt facilities ultimately end up making money?
So, I mean, this is a very typical debt facility in which there is a fixed cost that is there. It could be a fixed cost. And now, given the markets have become a lot more volatile, so most of the debt facility providers would do a percentage plus SOFR, right? SOFR is the Fed rates, which it's not prime, it's a little bit different, but it keeps on changing every month. There's a 1-month SOFR, there's a 3-month SOFR, and so on. And depending upon it, could take a 1-month or a 3-month SOFR. So most of the debt facility providers have moved away from the fixed cost. Now it's a variable cost in which there's a fixed component and there is a variable component, which is the SOFR that is there. And the other thing to keep in mind would be you have to get confidence from the debt facility providers through multiple things that are there. First is product, right? What type of product that you have, whether they deem it to be risky or not. If you're doing a product that's 4 years, it's a lot more risky than it's a 3-month product, right? The product itself. Second thing is background of the people, right? Whether if it's not you, whether it's a risk officer, it could be you, the background of people who is eventually going to be responsible for managing risk, right? It's extremely important to showcase that when you're speaking to a debt facility provider. They are evaluating you. No matter how smart you are, you could have raised $50, $70 million of fund. You have to understand that there's appreciation for risk, right? And you have somebody to back it up, right? The third thing is you have to walk the talk. What that means is you have to showcase your policy is reflective of what you understand, what you know, and you are not skimming it. What I mean is that you're not skimming it. You may know it, but when you're starting off, you're not doing the entire 9 yards. You're just getting the financials. So you have to walk the talk of your knowledge and reflect it on it. These are the 3 very important things that you need to keep in mind when you're raising. What is the product that you're thinking of? The second thing is you need to have a team to back it up, to showcase that they understand, they appreciate, and they're going to be the flag holders that the debt facility people can go up to. And the third thing is you need to showcase that what you are building is reflective of what you claim you're going to do.
And for founders to know, and also just for my own curiosity, like what kind of downside protections do you put in place to mitigate any kind of loss or full loss of capital deployed into your clients?
It is not, so for us as an example, it is not a collateralized loan, right? So the downside protection, technically speaking, is going to be your underwriting, right? So the downside protection is going to be where you are in terms of the money flow, right? The downside protection would be you do a pull from their bank account and not wait for them to push for their bank account. The downside protection would be how an early warning you get when the customer is probably deteriorating and not wait for it to become worse and not repay you. So those are some of the downside. You do not have, as it's not a collateralized loan, you do not technically have that downside protection in which you're covered completely, right? There's certain aspects of it. There are very few players that do it, but there are certain players that do it. Like, for example, you do a lockbox. So a lockbox would be when your end customer is repaying, it goes into this mutually owned bank account where instructions are given that what money can move in and what money can move out. So what that means is when the money comes into the lockbox, you tell them that, hey, I'm going to be paid my percentage first. There's a fixed fee percentage, and the remainder of it goes to the customer, the SaaS customer. That's another downside protection. Again, as you can imagine, the SaaS customers, they don't like it at all. A lot of friction, but sometimes you need to leverage it to protect it. Not a whole lot of companies are doing that today.
I think this is like such valuable insight for a lot of founders because there's so many tools out there, like there's Stripe and Shopify for those types of companies that are using it where they just, here, you get $500,000 or whatever, like instantly, but they don't really realize how it works, what kind of protections are there and how the payback periods work and interest rates and those types of things all work. So I really appreciate you kind of sharing your insight.
Jason, that is a very important point, and I try to educate people, right? Stripe Capital, Square Capital, Merchant Financing, and American Express. It's a very, very interesting product, but you need to understand the nuances of what is the effective API. So I always encourage people that whenever they say, it's a 6 months payout and I take only 25% or 30% of your revenue, but you paid off in 6 months, what you are thinking is cheap for you is actually a 24, 25% APR that is there, maybe even higher. I'm not even talking about the MCAs. I'm talking about some of these merchant financing companies through Square and Stripe and American Express that are there. You need to understand. I always encourage people to understand that what is the effective APR? Ask that question, and more often than not, they will answer you, and you'll be surprised that it's a lot higher than what you think it is.
Yeah, it can be very misleading, especially because it's not like a term loan where it's explicitly clear that you're paying like 10%, 20%, whatever. And I also think people haven't realized is how much interest rates have gone up. We're so used to like hearing these 3%, 5%, type terms, but even they're thinking like mortgage loans, which are very, very different than what business loans, come out when you're raising if you got a mortgage when it was like 3%, businesses are still paying like 8 to 10. And I think that education wasn't really there for a lot of founders that never went out and pursued debt. And now, I seeing interest rates and seeing venture, debt loans between like 18 to 30%.
Venture debt loan starts off from mid-teens and higher.
Yeah,
Mid-teens and higher starts off.
And I was just looking at a deal. We're helping a client right now find a new lender because they didn't read the fine print. They're like, oh, we got an 18% interest rate. It's not too bad. I was like, well, you got to read the covenants and what triggers the failure of the covenants and what happens when you default. And basically, the covenants were written to default. Like there was no way. It was absolutely impossible for them not to default. And then effective interest rate post default would be closer to 27% plus like a penalty on tap. And so it's just like, well, your actual interest rate is 27% because the moment they give you the money, within the first month, you're going to default with how this is written. And so being able to read that, fine print, being able to understand what the effective real rate will end up being, is something that I think a lot of founders really need to spend time, when they consider debt options.
Very, very interesting point that similarly with venture debt, like even for the best of best, like people who would not like an SVB is great in terms of venture debt that is there. They wouldn't have clauses like covenants that are there. However, there are other fees that people don't add up. Like for example, there is a closing fee. Your headline could be ABC. It could be 15%. There's a closing fee. There are warrants that are given, right? Warrants have fees, right? It could be 25 basis points to 100 basis points. Then there are concepts like minimum draw. So what that means is even if you don't need it, you need to take the money. And then there's a minimum draw. There is a concept of unused fees. What that means is if you're not doing it, you have to pay fees. So there's a lot of nuances, as you rightly pointed out, in venture debt that you need to be aware of and not be enamored by the headline, oh, I'm getting it at 16% or 17%. There are a lot of other fees that stack up very quickly.
Yeah, that's 100% true. And that's something that I spend a lot of time educating founders because a lot of founders come to me because they want venture. They have raised venture and they're familiar with this like VC that is, they know that 8 out of 10 of their bets probably go to zero. It's just like, that's the name of the game. Whereas debt, they don't lose money. Debt, debt lenders don't lose money. And that's like it's the opposite of venture. They have very predictable, returns and they have lots of downside protections to prevent, losses or mitigate losses or underwrite a portfolio of investments to, ensure that principal is never sacrificed. And so with that comes these additional fees that, founders need to be aware of and do their homework on. We talked a lot. I know we kind of picked your brain on, kind of all these different topics. I find it to be very interesting and more founders need to know about these options and know what could be out there for them. But what's the best way for founders to learn more about you and what you're doing at Efficient Capital?
I mean, like the easiest way would be we take pride in the fact that our website, which is ecaplabs.com, is fairly self-explanatory. Like people can reach out to me. I love talking to founders because I learn from them. I learn a lot. Happy, as I said, I still advise for 6 different fintechs around the globe. Love to see if people want to learn anything beyond this 45 minutes in our conversation. See if I can be of any help, whether it's SaaS, non-SaaS, fintech, non-fintech. But if people are very keen on learning very specifically about revenue-based financing, if people are very keen on learning specific about Efficient Capital Labs, they can go to ecaplabs.com and they can always reach out to me at Kaustav at ecaplabs.com. Fairly open to any sort of conversation where I can be of help.
No, I really appreciate that. And from what I hear, our guests often get hit up for various different things once the episode goes live. So hopefully founders take this as an opportunity to reach out and learn from you and build a relationship with you with that in mind. So I really appreciate you being on the show, sharing your insights, sharing your knowledge. I found this to be a very informative and educational episode. So hopefully our listeners do as well.
Really appreciate the fact for giving me an opportunity and a platform to talk about it.
Yeah, thank you for joining us. Appreciate it.
Thanks for listening to the show today. We hope you learned something valuable. And if you did, be sure to let us know in the comments or by hitting that like button. And if you're a founder looking to raise capital, then join us at Thunder.vc. We provide a free tool to help you identify which VC, family offices, or lenders are the best fit for you using our AI. It will save you a ton of time from chasing the wrong investors. And since launching our free tools, founders that have joined our network have gone on to raise over $1 billion in financing. Again, you can find these free tools at Thunder.vc. And as a reminder, we release new episodes every week. So stay informed by subscribing to our newsletter at join.thunder.vc. Again, that's join.thunder.vc. And if you or someone you know has recently raised a round and want to share your story, please email me at jason@thunder.vc. And that's our show. We hope you enjoyed it, and we see you next week.